Assalamualaikum and hi, my name is Wan Muhammad Farid Wan Zakaria, your course instructor for this topic. So, I will explain about the fundamental analysis, and this topic I will explain about the economic analysis and industry analysis. So, without further ado, let's get started. When it comes to the stock analysis, there are two main schools. The first one refers to the fundamental analysis, and the second one refers to the technical analysis. So fundamental analysis is all about using the concrete information about the company businesses, and we try to find the real value of the stock. Why the technical analysis concerned about the stock market movement and try to predict what happen next. Either we need to buy, sell, or hold. Good company are not necessarily make a good investment. That's why in fundamental analysis, conducting in-depth research on a company take a substantial amount of time, and there is a mountain of information that must be examined through in order to do it well. So in the end, what investor want is to compare the intrinsic value of a stock to its market value. Why? Why we need the intrinsic value? Because the stock of great company may be overpriced, and the stock of a lesser company may be a superior investment since it is undervalued. So that's why it's very important in fundamental analysis to find and to calculate the intrinsic value or the real value of the company. So what is the intrinsic value? So intrinsic value can be referred to the actual value of the stock as opposed to its market price of the book value. So this intrinsic value used by investors to compare with the security market price of the current price that quote in the stock market, with the aim of figuring out what sort of position to take with that security. So there are two decisions that we can make by using the intrinsic value. So the first one refers to the underprice. So when the intrinsic value is greater as compared to the market price, so the decision is to buy. When the intrinsic value is greater as compared to the market value, so resulted in overprice. So as an investor, we need to sell the security. Now, let's look the fundamental analysis in detail. So fundamental analysis refers to the process of looking at the business or company at the basic or fundamental financial level. So this type of analysis examines the key ratio of a business to determine its financial health and give an idea to the value of its stock. So this value refers to the intrinsic value. So many investors use fundamental analysis alone or in combination with the technical analysis. With this tool that refer to fundamental analysis is used to evaluate the stock for investment purposes. So that's why the objective of fundamental analysis is to determine the current value and more importantly, how the market value the stock. So that's why in fundamental analysis, as an investor, we concerned about the figure. So there are two frameworks of fundamental analysis. So the first one refers to the top-down approach and the second one refers to the bottom-up approach. So the top-down first approach refers to the top-down approach. In top-down approach, first we start by looking at the big picture. Big picture meaning that we need to look for the overall economic and condition in the securities market. We need to know which sector currently perform or outperform now, because this will give a better view or better insight about how the economy is performed right now. And after we finish analyzing the economic, okay, next we need to analyze the industry. Okay, meaning we need to pick the sector which particular company is operate. Then after that we can pick the company. Okay, we need to make an analysis which involves the qualitative and quantitative factors affecting the valuation model. And the second one refer to bottom up. Bottom up opposed to the top down approach, meaning that you start with the company, then you go for industry, and at the end of the analysis process, then you look for the economy. Okay, so now we look one by one component of top-down approach and bottom-up approach in detail. So we start with the economic analysis. So the economic is like the tide, and the various industry group and individual companies are like a boat. So the status of economic activity has a major impact on overall stock prices. So whatever happen in the economy will directly and indirectly give implication towards the business performance. For example, when the economy expands, most industry group and company benefit and grow. So you will see that at this time, most of investors start to jump into the stock market by buying the common stock. And when the economy decline, most sector and company usually suffer. So here you can see that the main market index that represented by FTSE, BMKLCI start to decline. Why this happen? Because investors start to pull out their investment. For example, banking and construction often hit hard times during economic recession. Why? Because during recession, okay, Monetary Policy Committee start to lower the rate of interest. So the bank need to bear or need to so the bank need to bear the loss because the interest rate is decreased as compared during to the good economy. But for food and retail, it less hit due to business still ongoing for consumer needs. So we can simplify that during the economic, the stock market will going to be bullish. And in the poor economic condition, the stock market will going to be bearish. So what's to look when we do the economic analysis? So we refer to the macroeconomic factors or variable. Okay, so economic growth can be analyzing by GDP. GDP refer to gross domestic product, okay, locally, regionally, and globally. So this also include the inflation and the price of commodity. The next factor that need to consider when you analyze the economy is the exchange rate between countries. So the rate at which domestic currency can be converted into foreign currency. And the second factor is the monetary policy by central bank. So this including either the monetary policy committee decided either to lowering or raising of the interest rate. And the last one by looking at the yield curve development. Okay, so after we finish with the economic analysis, then we start with the industry analysis. So we need to decide which sector or industry that hold promise for a good long-term growth. So this involves the reviewing back the economic, political, and market factors that the way industry develop. But bear in your mind, in Malaysia, the situation is very unique because some industry have a government interference. So you need to include this into your analysis. So in this stage, also the most promising sector are identified first. And then as an investor, we need to review the companies within that the sector to determine which individual stock will ultimately be purchased. Meaning that when you find the right sector, next you need to pick up the business or company that you want to buy. But you need to know the business cycle because the business cycle affect industry differently. So when we talk about business cycle, we refer to the fluctuation in economic activity that an economy experience over a period of time. By looking at the business cycle, you will know either the economy is expand or start to recess. So a business cycle is basically defined in terms of the period of expansion or recession. So that's why during expansion, the economy is growing in the real term. So as evident, this can be shown by increases in indicators like employment rate, industrial production, sales, and personal income. And during recession, the economy is contracting. So you will see all the business start to suffer. And this can be measured by decreases in the said indicator before. So other component of industry analysis that we need to look for is growth rate of industry, the type of industry, industry life cycle, nature of competition, nature of product, subsidies, incentive, and tax concession. So this is what I mean by the government interference. The tax frameworks, the import and export policy, the state of technology, social demographic trend that influence the supply and demand, and the last one is referred to the SWOT analysis. Then also you need to know the industry life cycle. So industry life cycle is divided into 4 different stages. So the first one is introduction. The second one followed by rapid growth, stable growth, slow growth, and the negative growth. And if we look to the life cycle of business, basically, so this refers to introduction, consolidation, maturity, and decline. So we start with the introduction phase. So introduction phase refers to the early stages of industry are often characterized by a new technology or product. So at this phase, it is difficult to predict which company will materialize as industry leader or which company will have the good prospect in the future. So some company will turn out to be widely successful. Some company will turn out to be widely successful and other will fail altogether. Thus, there is considerable risk in selecting one particular firm within this industry. So that's why when the company when investor decided to invest in company in introduction phase, they will think more than twice because this company or business known as a green leaf. Why green leaf? Because they just start their business. This is the new product. Okay, so after introduction phase, this business will move to the consolidation phase. So after a product becomes established, industry leader begin to emerge. So the survivor from the introduction phase are more stable and market share is easier to predict. So this is in the rapid growth phase. So thus the performance of the surviving company will more closely track the performance of the overall industry. So you can benchmark this company with the particular index. So when the industry still grow faster than the rest of the economy as the product penetrate the marketplace and become more commonly used. So the next phase refers to the maturity phase. So at this point, the product has reached its full potential for use by consumer. So the product has become far more standardized and producers are forced to compete to a greater extent on the basis of the price that lead to the narrower profit margin and further pressure on having reasonably stable cash flow but offering little opportunity for profitable expansion. So that's why if you are neutral investor, not a neutral investor, let's say you have a neutral risk tolerance or conservative risk tolerance, so you can invest in this company. Why? Because this company will pay you the stable dividend. Why? Because they have a plenty of cash. So this cash can be distribute out as a dividend. And the last phase refer to decline phase. So in decline phase, the industry might grow at less than the rate of the overall economy, or it might even shrink. So this could be due to the oldness of the product, meaning that there is no R&D for this product, or this product has reached its full potential, or they have a competition from the new low-cost supplier or competition from a new product. So you need to beware when the company enter into this phase. So now which phase is more attractive? So it depends to you as an investor, because different investor has different risk tolerance. Okay, investor can be divided either into aggressive, neutral, or conservative. But by refer to the Peter Lynch, okay, on One Up on Wall Street. Okay, so this published by New York, okay, by Penguin, page 131. So many people prefer to invest in high growth industry where there is a lot sound and a fury. But for Peter Lynch, it's big no. Why? Because Peter Lynch prefer to invest in a low growth industry. Because in a low growth industry, especially one that's boring and upset people, such as funeral home or the oil drum retrieval business, there is no problem with competition, because this business is less attractive to the others. So that's why you don't have to protect your flock from potential rival, and this gives you the leeway to continue to grow. So this is the perspective of the Peter Lynch. And so that's all from me. So hope you enjoy with my lecture. So anything, let's say you have any problem or you have some part that difficult to understand, feel free to reach me either by through email or through this platform. So hope you enjoy. Okay, stay safe and take care.